Well, hi traders, we're approaching the month end of August, where equity returns have been pretty good. We've just seen Nvidia coming out with earnings. They're very, very strong indeed. They probably just missed the buy-side consensus or the positioning in the market. We're seeing a bit of disappointment, I suppose, and a bit of positioning coming out, but I expect traders to look to buy the stock on weakness. We're seeing the US dollar down pretty much across G10, across the month of August. We'll see if there's better times ahead as we go into September, which is traditionally a bad time for equity returns, higher volatility, and certainly treasuries typically sell off in that situation as well. But we're watching the US dollar as it consolidates here. We're seeing a little bit of upside creep into the gold price. It looks to push into the top end of the range, and with Fed independence progressively getting called into question, perhaps that top end of the range can come in question sooner rather than later. There's a lot of charts coming on front of mind. We look at EURCAD, Euro New Zealand dollar as well, and we ask where the possibilities lie in that situation. Welcome to the trade-off. Well, hi, I'm Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And as always, we will be discussing the charts at front of mind, the news, the movers and shakers, and ask where the probabilities lie in this here market. Blake, coming to the programme, I've got a bit of a modest man cold. I'm being incredibly brave today. How are you going, buddy? You all right?
I'm doing great. We're towards the tail end of the summer, and when you live in the desert, that's usually a good thing.
Yeah.
So I'm doing good.
I'll tell you one thing that's made me really happy this morning and pulled me out of my incredible illness, and that is Man United losing to Grimsby in the FA Cup second round. So on penalties, you just can't get better than that, to be honest. So as happy as an Arsenal supporter, great to see Man United lose to a 4th division team. So I don't know if that means much to you guys out in the States.
It doesn't, but I love your enthusiasm about not supporting Man U. So
well, no, it's a David versus Goliath thing anyway. But it's great to see Man United in all sorts of pieces. But anyway, let's move into markets. Let's go back into topical thunder and see what's going on with the world. Well, we've got to go through Nvidia's earnings. It is the Mac Daddy, as you Americans like to say, of the earnings report. Obviously, it's been the epicenter and probably the cleanest way to play the AI thematic, which of course is the dominant thematic still very much in markets. They haven't resonated across futures markets as what we'd expect, but the stock's down 3% after hours, and I think people are looking to buy this into 172. There's 184 has been massive resistance, and that's the ceiling on the stock. But look, this is a business in absolute rude health. Their revenue numbers, $46.7 billion for Q2, pretty much in line with the buy side. They're above the sell side consensus. They've guided to 54 billion in Q3, the October quarter, give or take 2%. I think the market was looking for about 54.5, maybe 55 billion, probably why the stock's down a little bit. This is a victim of its own success. We know that always beat expectations on margins and sales. And on that point of margins, because when you look at semiconductors, it is a margin story. Their valuations are premised on margins. And, if you look what they've guided for in Q3, 73 to 74, let's say 73.5%, which are fantastic margins. But what's more important here is that they troughed in Q1, 71%. They've moved up in Q2, and then they're expected to sort of gravitate towards the mid-70s by the end of the year. And that's exactly what you want to see. So, their earnings, their revenues are all going in the right direction. They didn't report any numbers from China in the numbers. That was fully expected, but, we expect that to happen at some stage. The Blackwell business, the ramp there is going really effectively. We're still talking 17% sequential growth. GB200 is also working. Innovation's fine. And once they get past a lot of these sort of political issues, you're basically left with a stock with good earnings growth. If you're investing, return on equity of 91%, you can't sneeze at that. And it's still one of the cleanest ways to play AI, although, I think AM, Advanced Micro Devices, is still outperforming the stock year to date. So, look, great numbers. Markets expected it. A little bit of positioning coming around. I'm a buyer of dips on this. What do you think?
Well, I don't think there's any reason to be jumping off this train just yet, Chris. And I think you make all great points. But as you pointed out, maybe a bit of a victim of their own success at this stage. And one of the things I would also point out is that the stock is down. I mean, it's down 3%. It's very marginal. Where would you be looking to buy dips? Because I was looking at it technically, and I mean, I don't see support. You said you see support
Well,
around
172,
the
173. You've seen some a few times in the last couple of weeks. Goes down there, good buying. You've seen some long wicks on the, so there's good demand down in 172. But the trick for me now is you've got a 4.4 billion trillion market cap. To get above 184, which you can see has really been the supply zone. They're going to need to see something big. The macro through September may get a bit more of a challenging. And we're going to need to see something that causes the move through 184. And I think that's going to be a high hurdle. But if it does, I think to get into $200, they just need to keep doing something right. And I think the business is in fantastic shape. The earnings growth, the margin growth is in the right place. I guess a lot of it now really depends on the macro and whether the S&P and the NASDAQ and everything and sentiment continues to evolve, that you can break through that level.
Chris, I just, one of the things I want to point out technically about these really strong trends that are like this, you see support in the low 170s. I say just below 170. But even when you have such a strong trend like this, you look for false breakdowns. I look for moves maybe even below the mid 160s. Starts to shake the trees a little bit, shake some of the weak hands, and then you use those dips to be a buyer if you can get them. And that's the thing about strong trends is they don't reverse easy, and we didn't see anything in this report that really suggests that anybody should change their stance right now. I think
it's a core holding. Everyone owns the stock. I mean, there's got an 8% weight on the S&P, biggest weight you've ever seen for a single stock on the index. And you have to be in the stock if you're an investment manager. If you're active, and certainly if you're passive, you have to own it. But if you're an active manager, you have to own it just to achieve benchmark returns. Do you want to go overweight, or do you want to go into one of the other other stocks? Advanced Micro Devices is also in the GPU space. They're up 38% year to date. So I think people have been looking at that stock. Could you look at Broadcom? They're not an exact direct competitor in the sense they're not producing GPUs and data centers, but they're very much more in the ASICs play, and therefore producing chips more for inference side of things rather than the training side. And that stock's down up 29%. Maybe that's another play. So people are looking at Nvidia and saying this is still the best way, the cleanest play to play AI and that situation. But people are looking at other ways to look at it and express that. We'll have to see how China goes today, because some of their AI plays have been doing very well recently as well.
Yeah, I think Baidu actually reports at the end of the week, if I'm not mistaken. But anyway, let's talk about the broad market, Chris, because if you were looking for reasons to actually sell the market, it would have been today. It would have been this. Well, I say today. This for me, it's today. Tomorrow for you, whatever. After Nvidia earnings came out, and they're not bad. Nothing that should rock the boat. We're in a low volatility environment. I look at the equity markets, U.S. equity markets. They look like they're wedging higher. The Russell 2000 still looks great. Obviously the Nasdaq 100 is kind of squirmish up here, but still hanging tough. You look at European equities. The DAX is just consolidating in breakout territory. I think that in this low volatility environment, we still have several days until we hit the U.S. Labor Day holiday, which is this weekend. We have some big news that we're going to talk about, and going into next week, we'll talk about that here in a few minutes. Do you see any reason why stocks shouldn't hit all-time highs? Because at this stage in the game, when you have very low volatility and it's like this market's still a Teflon market, nothing has been able to move the needle at all. All we're doing is we're consolidating. We make gains. We consolidate. To me, it seems like a recipe to hit all-time highs once again. Now, I am a little. I want you all to stick around, because I do want to bring some charts, and I will bring some charts a little bit later to talk about the equity markets and risk, where we stand and where we might be able to go. But what are your thoughts, Chris, where we stand today?
Yeah, again, it comes down to you as a trader. Are you trading intraday? Trading 15, 30-minute charts, hourly charts. And obviously, when you go into those intraday timeframes, you do get long and short opportunities, and that's the whole different things. But if you're looking at the longer-term picture, go look daily, weekly charts, and looking at the big context, it's very difficult to be short. And it hurt because, the trend's higher, and, dips are very shallow. But yeah, I look at the internals at the moment. Now let's look at the sort of setups that we've got. Like you say, the Russell looks good, which is broken out, and the Russell's outperforming. So small caps are outperforming large caps at the moment. That's a positive for the whole sort of risk dynamic, and that's obviously a reflection of the modest Powell pivot, so to speak, that we saw at Jackson Hole. You look at the junkier end of town, the poor quality, the high gearing sort of stocks. High short interest stocks are still working well. They're outperforming. ARC Innovation's doing quite well on the sort of more specky side. High beta plays. There's a whole sort of raft of factors that I look at within this market that says people are not giving me any kind of reason to believe that there's a big shorting opportunity, a 5-10% drawdown at this stage. You go into the hedging markets, you go into the volatility channels. If you look at the implied volatility for 10 delta, put volatility on the S&P 1 month, there's still no relative demand relative to at the money. So people are not hedging those tail risks, 5 delta. People are not paying up to hedge their portfolios because hedges cost money in a market that's working. So go into the sort of the factors, go into the sort of the ratios of these different factors and the volatility channels. It's not giving me any major sort of red flags right now, and that will change. But when I start seeing that, then I'll start doing it. But right now, from the daily charts, from the high time frames, there's not much to suggest people are getting properly de-risked here. And maybe that'll change as past Labour Day. That's traditionally the time. Remember, seasonals. Anyway, I know there'll be a lot of people watching this who are into seasonals. And for what we don't know, that September is the worst month for equity returns in the S&P. We also know it's one of the worst months for bond market returns. But yields typically go up in this situation and volatility usually rises. So you seasonal ballers out there, you'll love a bit of that. September is traditionally that month, but if it's going to happen, it's going to happen. The other factor is, of course, Blake, and I think this is really important, and it may be a nothing burger, and it might be something pretty big, is that the US Treasury Department now are in the process of rebuilding their Treasury General account, the TGA, and they want to get up to sort of 800 billion over the next few months. And what happens then is that they do that by issuing short-term bills, and that will replenish the TGA. What that invariably means on the other side of the ledger is that the reserves in the banking system held by bank reserves that are held with the Fed are going to come down, and they're going to come down by sort of 600 billion or so. And reserves in the system are considered to be like liquidity, and liquidity is the oxygen in the market's lungs. So that could be an issue. It's possibly why September comes under pressure. That TGA goes up, reserves come out of the banking space off the Fed's balance sheet, and that may act as a headwind. We'll have to see. Obviously, there's a big couple of coupon issuance that come through as well, and that may suck liquidity out. So that is something that generally you need to understand the plumbing in the financial system to understand. But there is going to be liquidity coming out of the market over the next couple of months, and that may be something that sees equity risk coming under pressure.
There you go.
There you go. Another factor which I think is really interesting, market's not acting on it too much. Probably you could probably say that they're acting in the gold market, which we'll talk about in a minute, but that's been pushing up to sort of, looks like it's been grinding very slow volatility to the top end of its range, or near, it's got some way to go, but I think that's where it heads. But it's just this idea of Fed independence. I mean, it's been called into question for a while now, but we've got, Fed Governor Cook under all sorts of pressure because of related mortgage issues and the applications there, which obviously Trump wants to see her and Besson wants to see her stand down. She's refused to do so. And obviously Trump needs to take this to the courts now, which he may do today for cause. I still think that there's going to be a lengthy courtroom battle potentially in play. But what that does mean, if she was to be stood down, and we can't go against Trump's resolve to get her out of the position, is that you would end up seeing 4 members within the 7 governor positions within the Fed being impacted or put in place by Donald Trump. Obviously, they're going to be a puppet to him. So that gives the majority of Trump appointed Fed governors, the upper circles who have 14-year tenures with the Fed and get to vote every single meeting. What that's also important is because the regional Fed presidents, who have a sort of a rotational vote, their positions come up for renewal or reauthorization in February of next year, February 2026, and they need to be signed off by the Fed governors. And so if you've basically got a situation where you've got these Fed puppets in play, potentially the regional managers, regional Fed members become, orchestrated by a Trump appointee, and suddenly you get this massive loss of Fed independence. Of course, they still need to set policy, regardless of who they've been appointed to, to the economic realities. Because, if you get core PCE going up to 3.3% and, fairly resilient payrolls and good growth, and they cut rates, well, the market's going to say, you guys are completely politicized, it's ridiculous, and they'll just go and smash the US dollar. So they still need to have some credibility regardless of who's in place. But, I think this is a big talking point now about this fact that Trump stacked the courts, and now he's trying really hard to stack the Fed as well. And how are you seeing that? What are you talking about?
Well, we're talking about it a lot, Chris, and it is something that is a reality here in the United States. And I know that that the viewership here for the trade-off is not super heavy with North American traders, but my shows are, and it is something that we talk about quite a bit. And the other thing too, and I even get away from the Fed a little bit. People are talking about the military mobilization into Washington D.C., maybe other metro areas. Then you're also talking about the U.S. government taking stakes in Intel. I mean,
that's it's like Mussolini type stuff, isn't it?
Yeah, okay, so your words, not mine.
Oh, sorry. Have I understood them wrong?
I understand that U.S. government has taken stakes in certain companies, and I understand that it's usually during crisis. This is those stock markets at all-time highs. I understand Intel might need some capital, but we live in a capitalist society. I mean, if companies are struggling, you should let them fail. I mean, that's the bottom line.
Well, they're talking about Palantir as well, potentially maybe having to get a government stake in it because it's so strategically important to the US military and the government there that there's the talk that they might get a stake in them as well.
So, you throw all this together, Chris, and I start to think about credibility issues. I think we're in the early stages of all of this. Maybe not. Maybe we're in, if you're talking baseball, we might be in the second or third inning of this game, which on a 9-inning game typically. So yes, we have to worry about the Fed. Yes, there's a few things that as investors, and knowing that the dollar and U.S. equity markets are so central and investing topics globally, it's something that we should all be talking about. We probably will. Over time, I'm going to make an assumption.
I can see
Chris.
it now. When Blake's kids leave university, you can put him on the boat to Australia and say, so long, go to a better place. This place is crumbling. Short America.
Oh, I don't know about that. I'm about as big of a patriot as they come.
No, you should, mate. Greatest country in the world, apart from Australia.
Anyway. All right, let's move along. So, we got to get past this week. This week, I've been aching for this week to be over. Nvidia highlight today or tomorrow for you, but then we have or today for you, tomorrow for me. Anyway, however you want to say, we do have PCE at the end of the week, but really is next week that comes into center stage. And we have a holiday in the US, so just markets tend to be a little thin on Monday because there's a US and Canadian bank holiday. Just keep that in mind for you traders around the world. But next week, a lot of traders come off holiday in Europe, in the UK, in the US, all around the world. And so volatility tends to pick up, volumes start to pick up, and we've got a big week next week. We've got, not only do we have the jobs report, we have obviously ADP, and everybody's focused on US jobs, right? Which you should be. I was listening to another economist today talking about how our numbers may be coming down, also due to the fact that we're just not letting in a lot of
immigrants.
Immigrants. Thank you very much. It's late in the day for me. So a lot of immigrants in the U.S. so that the numbers getting lower aren't necessarily a huge concern at this point. You got to look at participation rate and unemployment rate and everything else. But we do have both ISM numbers that are coming out. We have Canadian employment. And we also have, JOLTS, jobs. We have Swiss CPI, which only comes out once a quarter. So there's a lot of data that's really coming out next week. I'm looking forward to next week. How about you, Chris? What are you looking forward to next week? And how important is the jobs report to you and the way we're going to be trading?
Well, I'm looking forward to the trade-off next week, obviously. Can't highlight the week. But no, I think the Swiss inflation number, obviously, is not going to be anywhere near as impactful as the payrolls number. But yeah, what we're looking now is a realistic situation that the Swiss National Bank are going to take their rates into negative territory, and obviously the CPI print will take that down. So people are expecting them to go into negative territory, which I don't know whether that's going to have a huge impact on the Swiss franc, but that's quite an interesting dynamic. And we do know 60% of G10 central banks at the moment have negative real rates and policy settings, and I think that's interesting as well. So that's obviously part of the reason why we're seeing risk here. But I think it's going to be payrolls. I mean, JOLTS is interesting because if you look at the totality of the data in the labour market, we look at the layoff rate and it's still very low. The quits rate's still okay, but the layoff rate's still really, and the market doesn't put a huge amount of weight to that. But so there's still a number of metrics within the labour market which is still pretty good. I mean, weekly claims are still pretty low, and the labour market's in good health in terms of the unemployment rate. So, but it is with the Fed, with Powell basically saying that our skew in the data now is much more symmetrical. In fact, we're going to put a little bit more weight on the payrolls number because it's harder to turn around the labour market than it is to quash inflation. And some people have said, well, that's not the right way to think. Inflation's going high. You can't really model it that well anyway. And I think it's really interesting if you go into the bond market that you've got real rates now which are falling quite precipitously. They're falling very, very sharply. 5-year real rates are at 1.2%, 112 basis points. And that's part of the reason why I think the gold market's sensing that real rates are falling because bond yields are gravitating a little bit lower, but inflation expectations are moving up. And so I think the real rate story is also helping the equity story because it's an easing of financial conditions. But I think payrolls, I mean, it's difficult to get a gauge now on expectations because you've only got a handful of economists who've put in their numbers. But, you're probably looking at around 80,000 as the sort of central figure at the moment on the payrolls number, which is still a pretty healthy number. But, to your point, where did supply, to get a break-even rate that sort of encapsulates a steady unemployment rate. I mean, all the economists are trying to say, what is the break-even rate for monthly employment growth that we need to see to keep the unemployment rate higher? And it's about 175,000 is what we're seeing at the moment. So, consistently below those numbers and big revisions down. So, I think it's going to be a difficult one to prophesise, and maybe we can talk about it next week. But everything's going to be around the payrolls number because the Fed have told us that they're looking at it very closely. And, when you're looking at data releases, Blake, and this comes, this is something you probably talk to your guys about, is if a central bank tells us they're interested in a certain thematic or a certain data point, you know that the market's going to put a lot of weight onto it. So when you're trying to manage risk around events and trying to understand propensity for movement, what does that mean for your positions? Do I want to look to cover it, cut it, add, whatever you want to see? When the Fed have told us that they're really looking at jobs, we know that the market's going to put huge weight on it, and therefore, it's going to have some big volatility potential for the US dollar rates, gold, all those factors. So payrolls. It's going to be an interesting one. Anyway, let's move on to the charts that matter. That's the setup. All right, we had a viewer question actually from on the YouTube channel. Dams the Man, I've heard him. Thank you, Dams, for your question. We've actually thought we'd cover both of these actually because I think whilst they kind of do the same thing in some capacities, Blake and I see the world sometimes very differently, and so we thought we'd look at both situations. Anyway, so for me, look, we saw a bit of a failed breakout. We tried to make a push through sort of 161, and then we got up into 162, failed at those levels, and we're just seeing this kind of series of two or three sort of lower lows and lower highs playing through. So I think a lot of the impetus is going. The market really loved the euro because of the fiscal issues that were going through, the fiscal spending, and we were seeing better growth coming, but it's obviously still pretty low. And what we'd also seen is that the ECB were getting close towards their rate cutting cycle as well, and that sort of the next cut's probably not till December now. But that's given up, and we've seen price roll over. The question is will this kick? I think there's probably some downside risk. So put a gun to my head. How do I play this? I'm trading this from the short side at the moment. Obviously looking to manage that if it sort of kicks back up and looks like it wants to make a play at 162. But I think EURCAD and maybe also Euro Aussie. I think Euro Aussie. I think there's some downside in that as well. So I'll be trading this from short side. Given that the trend needs work. I'll be keeping position sizes pretty small at the moment and looking to add, and if it does kick lower, build on the winning positions. But now I think there's probably a risk that this probably trades a little bit lower in the short term.
One thing I want to mention about that is those levels that recent high, it was matching levels that we haven't seen since 2009. So there's a ton of resistance, especially if you're on a weekly chart. Just keep looking left, look left for years, and you're going to see these are huge levels in the EURCAD, right where we stop. So, and that goes along the same lines with Euro New Zealand. And Dan, we wanted to cover both of these because you asked about them, but I think you bring up some really good charts here. The Euro Kiwi, it stopped right at resistance. This is a big level for the pair. Now, the one thing I do want to mention, because a lot of people technically, they look at that resistance and they go, ooh, double top. It isn't a double top. It's just resistance right now. It is resistance at a very key level of resistance. Like Chris says, they're both, not only this pair, the Euro Canadian, the Euro Aussie, they all look like they could trade lower in the very near term. The one thing you don't want to do is you want to make sure that you're not short on a breakout above these highs. Yeah. And that's where, double tops that you see here, or you call it a double top, everybody says that's key resistance. That means your stops go right above that. Because if we break out, it is not going to turn around and it's going to be a nasty move. And I don't know if you look back in April, or was it April? I believe it was May or April when we hit those highs. Those highs were hit because we were hitting some high volatility, and it was right after Liberation Day, and those moves are violent. I mean, I'm talking 300-400 pip moves. So if we break above that, there's usually a reason behind it, and you don't want to be stuck in that situation where there's a big breakout. I do think there's support, around the 50% level. You can see I've got a little support zone somewhere around the 197 level is probably going to be where you start to find some buyers, people that think this is going to eventually break higher.
Yeah, and I think don't forget as well with the RBNZ literally couldn't have been more dovish when they came out recently in their meeting. I mean, there's members calling for 50 basis point cuts now. They only cut by 25, but their growth forecasts were revised down. There's members calling for 50 basis point cuts. You're still talking about a central bank who have now lifted themselves as being one of the most dovish central banks out there, and that makes it very hard for a lot of people to buy the Kiwi dollar in that situation. But also when you're looking at euro, I mean, people are saying now, whilst we sort of flip to this kind of end of cycle rate cutting cycle, next cut perhaps in December, there is a risk as well that that market pricing is incorrect, and if anything, you're likely to price in more rate cuts in euro as well. So, it makes life a bit more of a challenge. But I think certainly it's very hard to buy the Kiwi dollar from a tactical perspective, just how dovish the RBNZ are at the moment. Okay, let's go to Bitcoin. I think Bitcoin's obviously got a lot of attention in the daily chart specifically. As you can see here, I mean, we got that former breakout, came down to test 112,000. We had the technical sort of trend break recently as well, but 112 there and thereabouts, if you're looking at our spot market, was obviously well-defined support. We broke through those levels. Obviously, we got a nice kicker up after Powell's sort of quasi-pivot, so to speak, and Ethereum had about a 14% rally on the day. But, it tested the top, it tested the former trend range, came back down, broke through 112,000 support with absolute ease on the day. But now, we've just seen a bit of sort of gentle buying coming back in. And what we're doing is we're testing the 5-day exponential moving average. I think we really need to see a break of that level to get this one pumping back up again, get a bit of momentum back into the rate of change pushing higher. Or, is this the level now? Because, you've seen a series of, lower highs. Is this the place now that we look to use this as exit liquidity, get out the trade? Some of the paper hands, weaker hands look to get down, and then obviously momentum picks up to the downside. So I wouldn't be buying now. The way I like to talk about this, as I talked about last week on the show, is I like to let others do the hard work for me. Let them buy the dip, which we're seeing at the moment, starting to see, but I like to buy the rip after the dip, and that means wait for the range to come in, or wait for a bit of volume in the futures market to come in, and look for price to hold above those very short-term moving averages on the higher time frames. We're not there yet. We could easily roll over, so that's why I said delicately poised. And then I like to I like to trade. I'm not talking about investing and all these factors that, people talking about, these 175,000 price targets and the cycles, looking at the alt season. I'm just talking about purely trading this one right now because I think it's a fantastic trading product. But I think the best way to do it is wait for the momentum to start putting up, and we're not seeing that yet. There's signs that it's putting in the base and it wants to do it, but I want to see where this kicks and then react accordingly.
Very nice, Chris. All right, I'm gonna turn your attention to crude oil, the slippery one, and the hidden oil slick.
Nice.
Donald Trump says that crude oil is going to drop below 60. Now, Donald Trump doesn't always get what Donald Trump wants, but President Trump did say this, and oftentimes he does get what he wants, and I think the market's taken notice. But technically, we should be looking at it as a bear flag pattern and understand that it's struggling with its previous lows around the $64 level. The 65 and 60, just above $65 is the 38% retracement. We stop there. And usually when you're talking about trends, when something stops at its 38% Fibonacci level, that means the bounce or the retracement is very shallow. That means that the trend that it's currently in is usually a pretty strong one. So in this case, that means the downtrend is still pretty strong. So a break below, $62 here, you're talking about a move back to $55, $56. That's where the flag's going to finish out, which is near all of those lows. It's not like crude oil is going to uncharted territory. This is levels that we've seen even this year, but it does seem poised. I'm using your term, Chris. It does seem poised to resume that downtrend and test levels below $60 now.
I just want to disclaim, I did not make up the word poised. It was actually started probably by the French at some stage. But yeah, I think it's interesting with crude because, like Donald Trump sort of conceded now that he's pretty happy with $60. He'd like to see it lower, obviously. But, obviously he won his campaigned very heavily on getting energy prices down to lower household inflation. And, if he's now sort of conceding that $60, he'd like to see it lower, but, this is a nice level for it to be at. And I think the other factor is if it does break $60, if the technicals do what, where you're suggesting the probabilities lie, then what you do is you obviously watching what's happening in US producers and, looking at oil rigs and stuff because they can shutter them pretty quickly. And what you do is you get a situation when it goes through that $60 level, you start, I think, below $55, where the target is. And that's where you start seeing oil rigs closing and, producers really looking at that because it doesn't cost. And that's where you get the natural handbrake on there. That's why you've seen such good support down there. So I'd love to see it down at $50, $55 because I'll be a buyer of that in size. I'll be starting to see any weakness in some of the E&P producers. I'll be a buyer of those on any weakness if we did see it get down to those levels because they're just going to be cutting back on production and that will see the price come down. So give it to me. Was that fill your boots?
Fill your boots. Fill my boots.
Yeah, I think that's it. For me, you trade the breakdown, go short and ride it down to $55. But then I think there's a good opportunity to flip it and look to go low. Remember the old saying, Blake's a bad trader of crude, but he's a bad caller, but a good trader of crude. Isn't that the one?
Other way around, but that's okay.
So it's early in the day for me. Anyway, let's go to play of the day. Well, last week I was actually looking at long China, short US. Now, that was working beautifully. I sort of took some off this morning on that position. I just want to sort of recap on that because China have outperformed a little bit too much to the point where you're seeing brokerages in the mainland actually looking to cut back on the level of speculation and raising margin levels to 100% in some cases, and financing has become more expensive for speculative situations. So they're just trying to take a bit of froth out of the market, and the CM50's taken a bit of a hit on that. So yeah, I'm sort of managing that one accordingly now. China has been a big outperformer. I want to bring up gold because it's a tough trade. It's boring as anything at the moment, isn't it, out of the gold market? You're really having to sort of fine-tune going to sort of 5-minute charts to really get anything. And such is the level of realised volatility and implied volatility that you're seeing in the gold market. But it's a real steady grind. I mean, I think people are looking at the investment case now and seeing some signs. If we do get a weak payrolls number next week, the dollar goes down. Obviously, we realise that rate cut in September, and we've still got CPI and core PCE this Friday to deal with. But, right now it's holding above the short-term moving averages. I think we get to the top end of the range, and that's my play. I think we get up there. Whether it can break that level is 34 30 into 50 is obviously yet to be seen. It would need a weak core PCE number, which gets the US dollar down. But I think go and have a look at real rates in the US. These are effectively TIPS, Treasury Inflation Protected Securities. So what they look at is the nominal Treasury yield, and they adjust it or deflate it relative to break-even inflation expectations. And real rates are falling pretty sharply at the moment. That is causing, it's underpinning the US dollar. It's keeping the US dollar suppressed. It should be making it fall, but it's not. And that's an interesting factor in itself. But, what it's doing is it's putting upside potential in the gold price. And so I think we get to the top end of the range. I think that's where the probabilities lie for me now. I'll be looking at scalps around those kind of levels because I think there's going to be a lot of heavy lifting to do through those levels. But I think right now, in terms of what we're seeing in real rates, and where the Fed are, I think, and also the independence of the central bank, which I think is giving gold real tailwinds at the moment, although I don't think Cook's going to be stood down anytime soon, if at all. I think we go to top end of the range here, Blake.
All right, Chris. Well, it seems like it's making its way up there. That's for sure. Well, let's take a look at my play of the day. Well, it is the S&P. I should mention last week I was looking at the dollar Mexican peso. I was looking for it to break above the 1880s level. Well, we hit there today in reverse, and I was actually in the chat room, my chat room today, saying, "Hey, if you guys want to sell dollar MEX, that was the place to do it." And it dropped, and it's still trading kind of heavy. So I haven't given up on that idea. I just haven't been long. Now with the S&P, you might remember from a couple weeks back, I was looking for wave 5 to complete up at these levels near here, above where we're at. I was looking at 65.50, 65.20. And it looks like we have this bullish wedge that's going to take us to all-time highs. Now, I still think, and I agree with what Westy said a little bit earlier, seasonals are not going to do the stock market any favors as we get into September. I do believe whether it's the jobs report, whether it's when President Trump announces a new Fed chair and maybe a super dovish one, stocks might spike higher. I believe there's going to be a place to be selling into, and that's why I put that question mark there. So whether it's 65.50, whether it's 6,600, it's somewhere up in this neighborhood as we hit all-time highs that I will start looking for a reversal level. So this is kind of an update from the last couple of weeks, but I believe we could be breaking into new highs over the next couple of days.
Yeah, who gets the gig? Who gets the gig of the Fed chair? I mean, I think Waller's probably front runner now, isn't he? It's
I think so, but you never know. You never know what yes man that he might throw in there.
Oh, so. Cheeky little man he is, Trump, isn't he? What a cheeky soul. Anyway, let's call it a day. While we're cooking. Thanks for all your thoughts here, Blake. I really appreciate it. Thanks for the viewer questions last week. Obviously, write them down. We try and address them whenever we can. Smash the like button if you like the show. And if I see you next week for more of the trade-off.